there's all manner of things they can do. Even things like stable coins are now a new source of treasuries that they can kind of just push out there. From the top level, countries are often trying to de-dollarize now around the margins, whereas the people are often not trying to de-dollarize. You don't see, if you go to the
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discusses Bitcoin and crypto. According to Lyn Alden, she is uncertain about when the breakout will occur, but once it does, it will have significant potential. We are currently in a period of anticipation, right in the midst of that move now, and it's one of those situations where you don't want to overanalyze it, like a financial analyst can become overbought in the short term. Individuals may be concerned. It seems that there may be a correction in the future, but it's uncertain and has been a bit unpredictable. It has been in a bear market since around 2011 and has been consolidating for the past 3 years. So, it's been quite a journey. Anticipate a significant Bitcoin surge here. The majority of the indicators she monitors suggest a fairly positive outlook. It seems that we are currently in the mid-cycle phase of the bull run. There is uncertainty about what will happen next. The next 18 months appear to be favorable for the asset as it closely follows global liquidity trends. Could you please provide on-chain indicators that demonstrate long-term holders' selling activity during the current market strength? Even if the price of Bitcoin increases significantly within a short time frame, it's important to consider the constrained supply. And lots of things Lyn Alden discusses, so please watch the video to end and share this video, and subscribe our channel, Everyday Finance. Thanks.
I think obfuscation is a kind of a key method there. And so when we go back to, say, 2019, for example, when the repo rate spike happened, you kind of describe it in financial jargon. You say, look, there's a repo problem. And for people that were kind of paying attention, including Luke, about looking at, the supply over issuance of T-bills versus, reserves and other kind of sources of liquidity, a lot of people were pointing out that they're going to have to start buying T-bills. And then they had to start buying T-bills, and it's like, well, why are you buying T-bills when you said you were going to be tightening, right? And you said you're going to be shrinking the balance sheet. And they never say, look, we have to kind of monetize fiscal deficits a little bit here. That's not how you phrase it. You phrase it as put it. You're dealing.
It's not QE. It's not
QE. It's not QE. It's just and so that's I think we'll probably see things like that. I mean, for example, fiscal dominance would be less inflationary if it imploded the private sector. So, for example, by raising rates so quickly, they blew out interest expense, but they also killed some of the banks. But when those banks started to fail, instead of letting deposits that are uninsured go bust, they bail out the deposits. And so they kind of soften what happens on the private sector while putting the gas on the public side. And that's where you get fiscal dominance being more inflationary. So it could include things like SLR rules changes, kind of, financial jargon that helps banks hold more treasuries, which is also basically what they did in the 1940s. It wasn't just the Fed monetizing all the treasuries. It was other pools of capital, including banks. And banks, because they have fractional reserve, policies, that they can hold quite a bit of treasuries depending on regulations around them. Especially if those treasuries are shorter term. And so there's all manner of things they can do. Even things like stable coins are now a new source of treasuries that they can kind of just push out there. From the top level, countries are often trying to de-dollarize now around the margins, whereas the people are often not trying to de-dollarize. You don't see, if you go to the currency markets in Cairo, it's dollars. It's not yuan. It's not yen, it's not everything else, it's dollars. And so in a lot of these different countries, stable coins have over 99% of the market share, is dollars, not other currencies. And so that's basically a new source of demand for T-bills. So I think there's a bunch of little levers they can pull to kind of put treasuries in a lot of different places. And I think that's probably going to be the name of the game for quite a while.
The price of Bitcoin experienced a significant drop of over 8.4% on April 13th, following an attack on Israel. Amidst the escalating geopolitical conflicts in the Middle East, the price of Bitcoin experienced a significant drop. Within minutes of the news of the attack, the price plummeted from around $67,000 to $61,620, resulting in a loss of over $130 million in market capitalization. This sudden sell-off has also impacted other cryptocurrencies. As of the current update, Ether has experienced a decrease of 9.81% to reach a value of $201,927, while Solana has seen a significant drop of 15.96% to $129, as reported by CoinMarketCap data. Additionally, the overall market capitalization of the cryptocurrency market has declined by 88.9% to $2.23 trillion, according to Bloomberg. Iran launched drones towards Israel on Saturday, April 13th. The action is seen as retaliation for an attack conducted by Israel days before, which targeted a diplomatic compound in Damascus, Syria. This attack resulted in the deaths of 7 Iranians, including 2 generals. In addition to the airstrikes, Iranian authorities have reportedly seized a cargo ship owned by a billionaire Israeli. On April 12th, United States President Joe Biden warned that Iran would launch attacks in the near future, emphasizing that the U.S. would provide assistance in defending Israel. "We are fully committed to the defense of Israel. We are committed to providing our unwavering support to Israel. We will support Israel and ensure that Iran does not achieve its goals." The ongoing conflict between Iran and Israel has intensified tensions in the region, which the U.S. has been working to prevent since the October 7, 2023 terrorist attacks by Hamas. This has resulted in a broader conflict between Israel and Hamas. U.S. officials have been advising Israel to avoid further escalating tensions in response to Iran. A government source informed CNN. The officials also expressed their frustration with the lack of prior information that Israel provided regarding its airstrike in Damascus. Israel reportedly notified a U.S. official about its planned airstrike on Syria only after its planes were already en route. The official stated that they were not aware of Israel's intentions beforehand, and the notification came just minutes before the strike occurred. Israel did not provide any specific details about the targets or location of the strike. Let's back to the Lyn Alden interview.
So I have a view on timing. I agree with that. And I've pointed out in some of my newsletters the concerns people had in the 80s and early 90s around the debt level. So, for example, the famous debt clock went up in 1988 or 89, and then Ross Perot ran the most successful independent presidential campaign in the early 90s, largely based on debt and deficit. That was kind of a main issue of his, and so that was like peak zeitgeist of that this matters. And if you look at the chart of interest expense as a percentage of GDP, that was peak interest expense because, even though federal debt was still fairly low, they had ultra high interest rates, and therefore they had, they looked like they had a spiral starting. Now, they had the fall of the Soviet Union, they had the opening up of China to the world, and then they had this kind of 30-year stretch of major globalization, interest rates falling from double digits all the way down to basically zero. And so, if I were to describe the fiscal problem in one kind of frame, it would be, we've had 40 years of rising debt to GDP, but it's been offset by 40 years of falling interest rates until we hit zero. And so if we just go, sideways now, let alone up, but if we just go sideways now, then we no longer have that offset of interest rates compared to the debt. And a lot of this is locked in, and now we're well over, 100% debt to GDP. And so I think it's almost ironic. I think basically because so many people freaked out in the 80s and 90s around the debt and deficit, that they, a lot of analysts then say, okay, that's kind of like they were way too premature. The lessons we learned is that debts and deficits don't matter. That's how a lot of people took that, right? They say, look, those people were wrong. And so
I think it's like a little bit of a boy who cried wolf syndrome.
Yeah. And I think and I think the pendulum has swung so far that now people are in the mindset that debts and deficits don't really matter, and it's starting to matter. And so, for example, we've had the longest period of the Conference Board leading indicator being in recession territory, and yet not having an official declared recession. We've had, PMIs went down. Normally bond yields go down when that happens. Instead, bond yields went up. And as Luke pointed out, that chart, gold and real rates diverging. The fact that the Federal Reserve had to come in and stop reducing their balance sheet in 2019 while there's still an economic expansion. These are all kind of things that start happening, and it's not like one Boolean outcome. Like now we go from not in fiscal dominance to permanently in fiscal dominance. But over the past, call it 5 years, there's been a number of pretty clear indicators that various signs of fiscal dominance and EM-like characteristics in the U.S. are building. And so I don't think it's a matter of like, okay, here, like 2028 is like the date that we're going to enter fiscal dominance. My view is basically ever since 2019 or so, we've roughly been flirting with it. That's fiscal is now a bigger factor than it normally is, and we don't have that 40-year offset in lower interest rates to offset that. And if somehow, let's say if AI comes and just completely gives us this massive disinflationary force and just kind of holds down, they're able to have low interest rates despite fairly high money supply growth. Well, then I still want to be in kind of the same assets that I'm in anyway, which I'd rather be in gold and Bitcoin than treasury bonds, for example, in that environment.
The BTC price experienced a decline over the weekend as a series of liquidations caused BTC to drop below $65,500. Meanwhile, altcoins encountered even more unfavorable conditions. According to the data, a significant number of the top 20 cryptocurrencies experienced a decline of over 15%. As a result, altcoins lost market share to Bitcoin. The recent highs indicated that the crypto market was heavily dominated by Bitcoin, resembling the market conditions in April 2021. I don't usually pay attention to Bitcoin dominance, but the chart C is quite impressive considering the constant influx of new altcoins in the market. Popular trader and social media commentator Bagi mentioned this in a response to fellow trader Don Crypto Trades. He pointed out the difference in the decline between Bitcoin and altcoins in recent days. The impact on Bitcoin's value in terms of dollars was minimal, and the overall downside was not significant. The real damage was seen in the altcoin sector, where billions of dollars in open interest resulted in price fluctuations of up to 50%. In the past, during the early stages of Bitcoin bull markets, there is usually a breakout in dominance, followed by altcoins catching up. However, in 2024, altcoins have been performing well without experiencing a prolonged consolidation period like Bitcoin. It's hard to predict what will happen next, but fellow trader Mikey Crypto believes that change is on the horizon. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.